Welcome back to the deep dive. Look, if you follow the financial news at all, you've probably sensed this. Well, this really strange situation. Global wealth. It's hit this mind-boggling number, $600 trillion. Unprecedented.
Just enormous. Highest ever recorded.
Right. But at the same time, the global economy feels, I don't know, incredibly fragile, like we're all skating on really thin ice.
It is the central puzzle, isn't it? Especially for anyone making big investment calls or policy decisions right now. And that's why we're diving into this McKinsey Global Institute analysis today.
They didn't just look at GDP, right?
No, that's the key. They've built what they call a global balance sheet. It's much more comprehensive, looking at assets, liabilities, the whole picture to gauge the world's economic health.
Okay, so what's our mission here today?
Well, our mission is to figure out why that huge $600 trillion number rests on such a shaky foundation. And crucially, what does all this mean for your wealth and for growth prospects looking out to, say, 2033?
All right, let's cut to the chase then. This global balance sheet tallying up everything from households, governments, companies. What did they find that's fundamentally off?
The core issue is a massive imbalance, a disproportion. Basically, global wealth and, importantly, global debt have shot up way, way faster than the actual productive economy, the GDP. It's supposed to support it all.
So like the financial house is way bigger than the foundation it's built on.
Exactly. It's towering, maybe a bit wobbly, and there's a real risk it could just tip over.
Okay, let's unpack that balance sheet idea a bit more.
Sure.
$600 trillion net worth globally. How did we actually build that? You'd normally think, new factories, innovation, that kind of thing.
Right. That's the common assumption.
Yeah.
But here's where the analysis gets really surprising. They talk about the rise of paper wealth.
Paper wealth.
Yeah. There's this critical disconnect between financial values going up and actual real investment happening. Get this. This is maybe the most startling number in the whole report. For every single dollar of actual productive new investment made globally over the last 25 years.
Like building stuff, R&D.
Exactly. New machines, infrastructure, research. For every $1 of that, the world somehow created $3.50 in new household wealth.
Whoa, wait. $3.50 of wealth for every $1 of real investment. Where did the other $2.50 come from? Is that the paper wealth part?
That's it precisely. Less than 30% of the wealth gains for households since the year 2000 actually came from genuine new investment. The biggest chunk, a massive 36%, they classify as pure paper wealth.
So just asset prices going up.
Pretty much. Housing prices, stock markets soaring, mainly because interest rates were incredibly low for a long time. Money was cheap, easy to borrow. People needed somewhere to park capital. It wasn't necessarily because the underlying real economy suddenly got, 3 times more productive.
Okay, that immediately explains the fragile feeling. Because paper wealth, unlike, say, a new bridge, can just, poof, vanish. Especially if interest rates go up, right?
Absolutely. It can disappear almost overnight if market sentiment changes or borrowing costs rise significantly. That wealth you see on your 401k statement, it's much more vulnerable than we maybe like to think.
And that's only half the story, I imagine.
Right. That's the asset side. The other side is the mountain of debt we took on to fuel this. It's the debt drag. It's not just that we created paper wealth. We borrowed like crazy to do it.
How much?
Remember the $1 of real investment creating $3.50 of wealth? Well, that same dollar of investment also came with $1.90 of new debt.
Wow. So for every dollar we actually built, we borrowed almost $2. That sounds incredibly inefficient.
It is. And it's pushed total global debt levels to near all-time highs.
Yeah.
We're talking about 2.6 times global GDP. That's huge.
Are there specific danger zones?
Oh, definitely.
Yeah.
The analysis points to some real hotspots. You've got Japan's government debt, which is just astronomical relative to its economy. And maybe even more concerning right now is China's non-financial corporate debt. It's at levels we've frankly never seen before.
And I guess when asset prices shoot up like that, it makes inequality worse, doesn't it? Because not everyone owns those assets.
It absolutely does. The benefits flowed mostly to those who already held the asset stocks, real estate. So the wealth concentration becomes much starker.
Oh, stark.
Well, across the major economies they looked at, the top 1% of households now hold at least 20% of all the national wealth. And in the U.S., it's even higher, about 35%. When asset prices drive growth, not wages or production, the gap just widens.
There was a really interesting point about the U.S. international position, too. America's negative net international investment position, the NIIP, it's big, like 90% of GDP. We usually blame trade deficits for that, right? U.S. buying more than it sells for decades.
That's the standard story. We owe the world more than they owe us because of trade. But the MGI analysis found something really counterintuitive here.
What's that?
Okay, so the U.S. is a huge net borrower. But listen to this. 70% of the increase in how much the U.S. owes the rest of the world since 2010, it wasn't driven by buying imports. It was driven by, well, by Wall Street being successful.
Hold on. Our financial success makes our international debt position look worse. How does that work?
Think about how the NIP is calculated. It's the value of foreign assets Americans own versus the value of U.S. assets foreigners own. Since 2010, U.S. stocks, Apple, Microsoft, Google, all those giants, they've massively outperformed global markets.
Okay.
So foreigners hold a lot of those U.S. stocks. As the value of those stocks rocketed up, the value of America's liabilities to the rest of the world grew much faster than the value of the foreign assets owned by Americans.
Ah, I get it. So every time a European pension fund saw its U.S. stocks soar, on paper, the U.S. debt to the world increased. That's a weird paradox. Our market strength creating a potential vulnerability.
Exactly. It just shows how interconnected and, frankly, how strange these global financial flows have become. And that brings us right back to the core question. What does this fragile, unbalanced system mean for you?
Right, because this isn't just abstract economics. The report actually models different paths forward through 2033. And the difference between the best case and worst case scenario, it's huge for individuals. We're talking a potential $160,000 swing in U.S. per capita wealth.
A massive difference.
Yeah.
That really brings it home, doesn't it? It affects your standard of living, your retirement plans, everything.
So let's walk through these four possible futures. What's the ideal path? The one we want.
That's scenario one, productivity acceleration. This is the only one that really solves the imbalance problem we've been talking about.
How?
It requires a big sustained boost in real productive investment and especially technology adoption. Basically, the real economy needs to grow fast enough to actually outpace the growth in debt and financial asset values.
So real growth catches up to and justifies the high valuation.
Precisely. If the world pulls this off, it rebalances the whole system. It validates the wealth we have on paper with real output, and it leads to continued healthy wealth growth. This scenario, they calculate, would boost U.S. per capita wealth by about $65,000 by 2033.
Okay, $65,000 up. That's the goal. What's the next scenario? Sustained inflation.
Right. Scenario two. If inflation stays stubbornly high, it does something mathematically interesting to the balance sheet ratios.
How so?
Well, high inflation pushes up nominal GDP, the bottom part of those debt to GDP or wealth to GDP fractions. When the denominator grows fast, the ratio itself shrinks.
So it looks like the debt burden is getting smaller, which sounds good.
On paper, yes, it looks like a correction. But it's a painful way to get there. High inflation hammers real wealth. Your savings buy less. Household budgets get squeezed. Businesses can't plan properly. The balance sheet ratios might look a bit better, but the actual quality of life, the real value, is eroded.
Not a great path either. Okay, scenario three. Return to past era. This sounds like secular stagnation, like the 2010s.
Exactly. Think low growth, low investment, companies sitting on cash, super low interest rates, that kind of environment.
What happens to wealth then?
Wealth probably still grows a bit in this scenario, but it's mostly that paper wealth again. The underlying productive engine is just sputtering along. All those vulnerabilities we discussed, the high debt, the reliance on asset prices, they just stick around, maybe even get worse. The risk keeps building.
And the report flags this as a particular risk for Europe.
Yes, especially the Eurozone, Germany, for instance. If they get stuck in this low-growth rut, the report suggests their GDP per capita gap compared to the U.S. could widen by another $19,000. It's a slow drift, a loss of dynamism that's really hard to escape once you're in it.
And then there's the worst case, scenario four, balance sheet reset.
This is the one everyone fears. The painful, sharp correction. Something triggers it, maybe a geopolitical crisis, a major bank failure, perhaps a policy mistake on interest rates.
And asset prices plummet.
Exactly. Asset prices fall hard and fast, wiping out trillions in that paper wealth. This forces households, companies, maybe even governments into a long, painful period of deleveraging. Just focusing on paying down debt, not investing or spending.
Like a lost decade.
Precisely. Think Japan in the 1990s. Years of stagnant growth and economic malaise. This is the scenario where U.S. per capita wealth takes a massive hit, dropping by an estimated $95,000.
Wow. So minus $95,000 in that scenario, plus $65,000 in the best case. That's the $160,000 swing. The stakes are incredibly high.
They really are. Choosing the right path, or rather making the right path happen, is critical.
And achieving that best path, the productivity acceleration one, it sounds like it requires some big changes and probably coordination between the major economies.
Absolutely. The MGI analysis really stresses this point. It requires what they call a kind of role reversal among the world's economic giants. And if one region fails to make its shift, it drags the others down. It's deeply interdependent.
Okay, let's break that down. What's the prescription for the United States?
For the U.S., the message is clear. Save more and borrow less.
Why specifically the U.S.?
Well, the U.S. is sitting on some significant vulnerabilities. Equity valuations are really high, almost back to dot-com bubble levels in some metrics. And government debt is huge, nearly 120% of GDP. Plus, those fiscal deficits are still wide, around 7% of GDP currently. So the risk is high if something goes wrong? Yes. To avoid triggering that painful reset, the U.S. really needs to get its fiscal house in order. Reduce the deficit, rely less on borrowing to fund consumption, basically shore up the foundations.
Okay, U.S. saves more. What about Europe? Their problem seems to be the opposite, stagnation.
Completely different prescription. For the Eurozone, it's invest more.
They need to kickstart growth.
Exactly. Europe is really flirting with that secular stagnation scenario. The core issue is a lack of investment in future productivity. The report highlights a massive gap. In 2022, European companies spent $700 billion less on capital investment and R&D than their U.S. counterparts.
$700 billion less. That's enormous.
It is. So to close that gap and avoid stagnation, Europe needs a major push in productive investment. This might mean using public balance sheets more effectively, even in traditionally cautious countries like Germany, to fund things like infrastructure, green technology, digital transformation.
So U.S. saves, Europe invests. What about the third major player, China? They have their own unique challenges, especially with the property sector, right?
They certainly do. For China, the prescription is consume more.
Shift the whole economic model.
Fundamentally, yes. China's growth for decades relied heavily on massive investment, particularly in property and infrastructure and on exports. That model is running out of steam, partly due to demographics, trade tensions, and the sheer scale of past investment.
So they need their own population to buy more stuff.
Pretty much. To counterbalance the slowdown in property and exports, they need a significant structural shift towards domestic household consumption. The report estimates consumption needs to rise by something like 6 percentage points of GDP by 2033.
6 percentage points of GDP shifted to consumption in a decade. That sounds like a monumental task.
It's a huge rebalancing act, but it's critical, not just for China, but for the world.
Why is it so critical globally?
Because if China doesn't manage this shift, the risks pile up internally. Remember that massive corporate debt we mentioned. It's about 1.8 times their GDP, double the global average. If the old growth drivers falter and consumption doesn't pick up the slack, you could see a major domestic financial crisis in China.
Which would definitely not stay contained within China.
No way. It would send massive shockwaves through the entire global economy. So their success in boosting consumption is really key to avoiding negative scenarios for everyone.
Okay, so it's this intricate dance then. The U.S. needs to tighten its belt, save more. Europe needs to open the investment taps. China needs to get its consumer spending. That's the path to the good scenario, the productivity acceleration.
That's the roadmap laid out in the analysis, yes. It's the pathway to rebalancing the global economy, validating that $600 trillion in wealth, and achieving that potential $65,000 per capita gain.
It sounds difficult. A lot of coordination, a lot of tough political choices in each region.
Extremely difficult. It requires genuine structural changes, overcoming inertia, potentially facing short-term political pain for long-term gain. That's the critical choice. Can the big three execute this kind of fundamental role reversal? Or do the imbalances just fester, leading us towards stagnation, or worse, that painful reset?
And when we think about who actually drives these changes, we often focus on governments, central banks, but the report had a different take on where the real power lies to shift us onto that better path, didn't it?
It did, and it's a crucial point to end on. While policymakers absolutely set the stage, create the incentives, manage the risks, the ultimate determinant of which scenario we end up in, it rests fundamentally with the private sector.
With businesses.
Yes. Businesses aren't just sitting on the sidelines waiting for instructions. The report makes it really clear. There are collective decisions about where and how much to invest in productive assets, in R&D, in new technologies, in their workforce. That is the engine that will actually drive us towards productivity acceleration.
So it's the sum of millions of individual business decisions that will ultimately steer the ship.
Exactly. Their willingness to invest in the real economy, not just financial maneuvering, is what will determine whether that $600 trillion rests on solid ground or remains perched precariously on paper. That's the real driving force for the decade ahead.